Ladies and gentlemen, welcome to Albaraka Full Year 2018 Financial Results Conference Call. I will now hand over to Mr. Malik Khudr Timsa, Executive Vice President. Sir, please go ahead.
Hi, good afternoon, everyone. Welcome to our year-end 2018 earnings call. In light of some of the constructive feedback we actually received last time with regards to diving straight into our financials as opposed to consuming too much of everyone's time, let me therefore just go ahead and commence straight on slide 3 of our presentation. So I'll start with the balance sheet. Despite what has been a very challenging, self-admittedly, fourth quarter, I think following the August lira devaluation and its obvious subsequent, impact, we did manage to achieve some measured growth of our assets, the funding credits portfolio, as well as funds collected in comparison to the end of 2017. In large part, driven, I think, by the inflation of our balance sheet stemming from the lira depreciation, our asset size expanded by roughly 16.5% year on year to reach about 42 billion. The total funded credits book showed a bit more of a humble year-on-year growth of only 4%, reaching about 26.2 billion, on the back of our more cautious approach, frankly speaking, to balance sheet growth, given the challenges we're seeing in the operating environment, as well as our emphasis on a more balanced approach to deleveraging balance sheet. Our funded credits book now constitutes about 62% of our total assets at the end of last year. Still, of course, an important component of total assets despite the slower growth that we witnessed. If you break down that loan book in terms of currency, roughly give or take 46% is Turkish lira based and roughly 54% is foreign currency based. Deposits, or our total collected funds, on the other hand, grew by around 13% year on year, reaching 28.6 billion. The result of this is, of course, that our aggregate loan to deposit ratio now stands at around 91.5%, roughly 4% less than the participation banking sector average, and about 24%, in fact, less than the banking sector, which has a loan to deposit ratio now of about 115%. Going on to shareholders' equity, as many of you perhaps recall, last year we did a Tier 1 $205 million issue. Thanks in large part to the contribution of that instrument, our equity increased to about roughly 3.26 billion, representing about 31% year-on-year growth. Our CAR declined about 240 basis points to reach 14.66% at the end of last year, whereas our Tier 1 capital ratio has come down slightly, about 11 basis points, to reach about 9.98%. In terms of NPL volumes, I know everyone's obviously taking a very close look at these across the banking sector. We witnessed an increase of about 56% roughly in our total stage 3 credit stock, which ended up the year at about 1.89 billion. Now, I do want to emphasize this was more or less in line with the banking sector, which witnessed, in fact, a year-on-year NPL growth of 51%, whereas the participation banking sector also witnessed a corresponding increase of about 50%. Our NPL ratio did inch up to 6.88% from 4.68% of the prior year. But again, I would mention here that the deterioration in our NPL ratio did not just come from our similar to market NPL formation, but also rather the muted growth in our overall funded credits book. So naturally, there's a negative denominator effect impacting the NPL ratio. Now, moving on to the income statement, after adjusting, as many of you recall, the 233 million lira profit share income from our joint venture projects in 2017, our adjusted net profit share margin declined about 1.5% year on year to reach about 1 billion liras at the end of last year. This pretty much represents or equals a net profit share margin of about 2.94%, which came down about 41 basis points when you compare it to our net profit share margin at the end of 2017. Net fees and commissions witnessed quite healthy growth, about 33.5% year on year, reaching about 198 million in 2018. Now, the growth in this line item is coming from rising revenues from point of sale services, as well as fees on some new products like custody accounts, which we began offering investors during the year. The non-funded credit book, despite the slowdown that we've been seeing in the Turkish economy, has helped to boost this figure, and I think certainly reflects our emphasis on positioning ourselves as an SME-friendly bank that can meet the trade finance requirements of the Turkish economy. Now, obviously, as a result of the ongoing implications of IFRS 9, as well as the rebalancing we're seeing in the macroeconomic environment, our provisions for loan losses expanded by about 32% year on year to 608 million liras. It is worth mentioning here again that overall provisioning at the banking sector in Turkey at large increased by almost 100% over the same period. Our total coverage ratio stood at around 66.5% and compared to about, give or take, 69.5% a year prior to that, whereas our coverage for stage 3 credits stood at about 47.3% at the end of last year. Total operating expenses grew by about 39.2% year on year, leading to a deterioration in our cost-to-income ratio, which expanded from about 53% to about 60%. HR costs, when you look at those, grew about 21% year on year in line with inflation, whereas our non-HR expenses grew by around 60% year on year. And I will just note here that that 60% year on year growth was inflated by a one-off 210 million lira revaluation loss related to an asset. I do believe it is again worth noting that, despite the branch expansion that we went through in 2018, we added about 10 branches, give or take, and a marginal increase in staff of about 89 personnel. Headline cost growth would have actually been 14% year on year after adjusting for this expected one-off expense. So obviously this all brings us down to our net profit. Net profits came in year-end at around 134 million liras, marking a 43.5% year-on-year drop and resulting in a quite humble ROE of 4.3%, which will be going in later on the call. Moving on to slide 4, main highlights. I think there are no doubts that the biggest sort of standout thing right now, development, is the considerable drop in our bottom line profitability when you compare the year-end 2017 to the year-end 2018, or if you do it on a quarter-to-quarter basis. I think the reality is that we are facing considerable headwinds as a result of various factors. There is a gradual and somewhat of a structural change in our funding mix towards more higher pricing competitive deposit products, such as lira sukuks, as well as other new participation banking industry products, which naturally is adding to some pressures on the weighted average cost of funding side. Despite the higher rate environment, loan repricing on our asset side is coming with a bit of a lag, and in our case particularly taking into account the limited new loan growth. Third of all, these factors are naturally putting pressure on our margins, something which of course we're seeing across the Turkish banking sector at the moment, particularly when we see that loan to deposit spreads on Turkish lira are approaching flat levels. Again, the inflationary environment is continuing to add to operating expenses, and I believe moving forward we will be in line with our banking peers, continuing to take a closer look at how we can increase operational efficiency. So, as a result of these factors, our reported net profit share margin dropped in 2018 and stood at around 2.8%. That was about a 120 basis point drop from the year prior. Again, once we adjust for joint venture projects, our adjusted net profit share margin came in at around 2.94%, which corresponds to a bit more acceptable 40 basis point contraction over a year ago. Overall, our capital adequacy ratio of 14.66% still remains, I believe, comfortably above the regulator's comfort threshold of 12% and certainly well above Basel III requirement of 8%. Whereas the drop that we witnessed in our core equity ratio, which ended the year at 7.56%, reflects the bottom line loss we booked in the last quarter of last year on a standalone basis. Nevertheless, our AT1 sukuk has provided some cushion to the overall capital adequacy ratio. So moving on to slide 5, asset composition. Let me just start with the upper left-hand corner. We are seeing somewhat of a change, albeit marginal, in asset composition. When you look at the end of 2018, our funded credits portfolio represented 62% of our total assets, whereas at the end of 2017 it was about 68%. Now, our securities portfolio now represents about 7% of our total assets, and that has expanded to roughly about 3 billion liras at the end of last year. I'll just mention that about 55% of this 3 billion lira securities portfolio is all Turkish government sukuks, of which 85% are lira denominated and the remaining portion foreign currency denominated. We have seen a good yield pickup on the securities portfolio, which has increased about give or take 308 basis points, and now is sitting at around 12.85% as a weighted yield. Let me also obviously emphasize what's going on with liquid assets, because clearly what we've seen in terms of our balance sheet is, given our bit more of our cautious and perhaps balanced approach to extending credits, given the status quo on the ground, a lot of that maturing loans has sort of come in, and we've decided to sort of strengthen our liquidity coffers. So when you look at our liquid assets, and liquid assets, I specifically mean cash and cash equivalents, those now represent, give or take, about 26.4% of the balance sheet. Obviously, the drop in our outstanding funded credits portfolio as a percentage of our assets has filtered through on the back of this more conservative loan-to-deposit ratios and have led to this buildup in high-quality assets I've been referring to. This, of course, has come at the relative opportunity cost of profitability, since usually high-quality assets don't generate the same kind of yield pickup as naturally funded credits. Now, with regards to these high-quality liquid assets, they now represent in total about 32% of the balance sheet. And as I mentioned earlier, the high percentage of high-quality liquid assets for us is in essence a mitigant to the challenging operating environment. During the fourth quarter of last year, our average liquidity coverage ratios on both our foreign currency as well as lira liquidity on aggregate were comfortably 3-4 times the regulatory requirements. I won't go into too much detail about cash and balances with central bank and interbank placements. These obviously fall under high quality liquid assets, but in a nutshell, our positions there almost doubled from the end of 2017 to 2018, again in line with our cautious and balanced approach to managing the balance sheet. Moving on to slides 6 and 7, I'll consolidate my comments here in terms of operating performance breakdown as well as the funded credits portfolio. So let me begin with the cost and yield movement. The yield on our blended funded credits portfolio dropped about 24 basis points year on year to reach 10%. If we look at the blended loan book yield breakdown as of the end of 2018, our loan yield was actually 10.4%, representing a 60 basis points increase from 2017. Blended cost of collected funds, obviously an important item, increased about 119 basis points year on year to reach about 6.78%. And our reported net profit share margin narrowed about 122 basis points year on year to reach 2.8%. In terms of headline figures related to profit share income, our headline profit share income last year increased 13.6% year on year to close the year at about 3.02 billion liras. Now, obviously, a profit share income from our funded credits portfolio represented about 88% of the entire headline figure. When we look at our strong liquidity position at the moment due to our lower loan-to-deposit ratio, we believe we are better equipped to deliver, I believe, stronger lending expansion in the second half of this year, when we expect to see loan rates in the market, frankly speaking, come down to nominal levels which are a bit more acceptable, and which can in fact both trigger loan demand and at the same time ensure enhanced debt servicing capacity of borrowers. So we do not expect a structural change in our profit share income composition in the near future. Now, when it comes to the details of the yield on this loan or funded credit portfolio, what we're seeing is that the lira funded credit portfolio yield has slightly declined 20 basis points year on year, whereas the foreign currency funded credit portfolio yield has actually increased about 140 basis points year on year. Moving on to profit share expenses, our headline profit share expenses increased a considerable amount, about 43%, to reach about 2 billion. Now, due to the change in our funding mix, which I was mentioning a bit earlier to you all, and due to you're looking at the weaker lira, looking at the composition of profit share expenses did change in 2018, and specifically in the fourth quarter of last year. 72% of our total profit share expenses were composed of collected funds in 2017, but this ratio has now dropped to 67% at the end of 2018. We may see a similar pattern continue at least into the first half of 2019. Obviously, the downward path of inflation is supposed to bring down cost of lira funding in the second half of next year, so that our funding mix normalizes in favor of participation accounts. Now, when it comes to the details of our funding costs, what we're basically seeing is that our blended deposit cost has increased to about 6.78%. Our lira deposit costs have increased to around 11.31%. and our foreign currency deposit cost has increased 61 basis points year on year to reach about 2.47%. Let me just go into a bit more detail on the wholesale funding side, because that to us is where there will certainly be some changes moving forward. Now, expenses related to wholesale funding now represent about 33% of our entire profit share expenses. As mentioned earlier, the rising exposure to lira-denominated sukuks on our liability side and the new competitive return deposit products which we've been offering some of our price-sensitive customers, as well as, frankly speaking, the rise in market funding costs for Turkish issuers, has all kind of led to this pent-up, in essence, increase in funding costs. Now, from obviously our point of view, we will see the expenses of wholesale funding cooling down in the second half of last year, in line with the anticipated decline in inflation, but as well in line with our ongoing foreign currency deleveraging on the liability side, which will provide some significant relief for our own balance sheet, our own income statement, commencing in the second half of the year, where most of our global market transactions will be repaid. Net profit share income came in around 1 billion in 2018. Though contracting by about 20% year on year, our adjusted net profit share income remained almost flat. Now, just a very quick note in terms of other notable income statement line items. Net fees and commissions were they've actually done quite well for us. Our net fees and commissions reached about 198 million last year, roughly 33.5% year-on-year expansion in this line item. As I mentioned earlier, did come from higher POS commissions and custody services. Net fees related to our non-cash credit book and our banking operations income also did well due to the continued growth of our off-balance sheet business, which helped to offset somewhat the sluggish, if you want, performance on the cash credit side. Trading income for us last year also gave a big boost, obviously, to the bottom line. Trading income last year increased almost eightfold to reach about 346 million liras, thanks in large part to the contribution coming from our FX position stemming from our Tier 1 sukuk. Funded credits composition, I may have mentioned this earlier, the funded credits portfolio today is about 46% lira denominated, for 54% foreign currency, whereas our corporate and SME exposure is about 48 and 42% respectively, with the remaining 10%, give or take, being retail. Let's move on to slide 8, which is asset quality. Now, I know this is obviously a very, again, important aspect for everyone here. Our NPL ratio, as I had mentioned earlier, did inch up to close the year at 6.88%, and it did increase about 2.2% throughout the year. While NPL inflows increased in 2018 due to the economic environment, obviously our ratio itself was also impacted by very muted loan growth. And it's something I will continue, I think, to emphasize over and over again, because we did not aggressively grow the loan book and, in essence, deflate that NPL ratio artificially. Our Stage 3 NPL coverage of 47%, combined with some of the over-collateralization in our funded credits portfolio, does provide some mitigants. When we look at our gross funded credit portfolio by stages, what we see is that our Stage 1 credits now represent about 73.7% of total extended credits. Stage 2 credits represent around 19.4%, those under close monitoring, and the Stage 3 credits are around 6.88%. In terms of cost of risk, our trading 4 quarters gross cost of risk stood at around 203 basis points at the end of last year, and that was only a marginal increase of about 14 basis points comparing it to the prior year. In terms of asset quality, on slide 9, our gross NPL inflows in the 4th quarter of last year were actually parallel to the banking sector average, with about 440 million. But our NPL recoveries actually doubled in the last quarter of the year, in compared to the 3rd quarter, where inflows or where recoveries mounted to about 253 million. So this was obviously much lower compared to 336 million in the 3rd quarter. So when you look at our net NPL formation rate, it has climbed down considerably to around 272 basis points in the last quarter of 2018, when you compare it actually to the 3rd quarter, where that NPL formation rate was at a much higher elevated 475 basis points. Very quickly, in terms of where are the gross new NPL additions coming from in terms of sectors in our balance sheet, we witnessed about 1.4 billion gross NPL inflows, as I had mentioned a bit earlier last year. Construction, manufacturing, and wholesale trade were the main areas that those NPL inflows came from. When it comes to the sector breakdown of our stage 2 credits, which in total amount to about 5.3 billion liras, the manufacturing industry dominated with about a 28.7% stake, followed by construction with about a 27.8% representation. So although our cash coverage is low at 5.6% for stage 2 loans, we do have strong collateral, and we believe that this strong collateral does provide some mitigants. We also have about a 47.3% cash coverage for our stage 3 loans, but again, with about a 1.25 billion collateral portfolio, we are comfortable. Let me close up very quickly the session before moving this on to our CEO, Malik Shah Utku, in terms of Q&A on talking about funding profile. And I think this is obviously very important because ultimately we cannot talk about the profitability outlook and the balance outlook in general without talking about the source of where all this comes from, which is funding. So when you look at our wholesale funding, which now represents about 21% of our liabilities, yes, those increased 20% year on year in 2018, but I want to just remind everyone this came from the Turkish lira depreciation, because in fact, in nominal terms, we have been very gradually and in a balanced manner deleveraging our foreign currency liabilities, and we certainly believe it will put us in a much better position moving forward. Now, this year we have two major transactions, a June Sukuk as well as an April syndication. As we had indicated to some of our investment partners, even though we cannot perhaps explicitly state our plans on it, but what we can say is that we're going to approach it with the same mindset, which is an emphasis on foreign currency liability deleveraging, and we can all read in between the lines about that. In terms of shareholders' equity, that's about 8% of basically the entire liabilities or our funding now. That increased about 31% year on year, and as I mentioned earlier, this increase did come from the Tier 1 Sukuk we did last year. In terms of collected funds breakdown, our aggregate deposit base increased about 13% last year to reach 28.6 billion liras. The breakdown of our total deposit base for the same period in terms of lira versus foreign currency deposits was about 41% to 59% respectively. So in terms of trends that we're seeing, in terms of how I explained earlier, the structural changes we're seeing on the liability side, we have seen our lira current accounts actually contract 12.1% year on year. Our lira participation accounts contract 10.8% year on year. Foreign currency current accounts increased 6.8% year on year in real terms, and the foreign currency participation accounts did decline a marginal 3.7% year on year. However, the aggregate contraction which we witnessed in these accounts, specifically in the last quarter of last year, was mostly captured by effective migrations to these newer price competitive deposit products, which I had mentioned earlier, albeit at a marginal cost of profitability. So in terms of cost of funds collected, lira cost of funding increased to about 11.31%. Foreign currency cost of funding increased to about 2.47%, and our average weighted cost of funding increased to about 6.78%. Let me move on to the off-balance sheet items. So total off-balance sheet commitments increased about 9% year on year, reaching about 12.4 billion liras. I certainly think that the growth we've seen in the off-balance sheet item has been, for me at least, a success story and something positive to look at. It does reflect a healthy growth, growth in terms of our approach in the market paying off, given that we've seen levels there which are actually outpacing the market. In terms of slide 15, income cost dynamics, I'll just skip that since our CEO, Malik Shah, if there's any Q&A on that, can go into them. And lastly, financial ratios, sector comparison, slide 16, which is where I'll round things up here. So again, financial ratios reflect a fairly clear picture for us all. I believe we are all facing the same headwinds and trends, albeit to different degrees. And yes, we are going through a bit of a period of operational margin pressures given temporary market dynamics and witnessing the pass-through effects of the August depreciation on our asset quality and provisioning, which I think combined with the inflationary environment explains the significant pressures on bottom lines profitability across the sector and Albaraka Turk. Yet, we are cautiously optimistic that a turnaround in the second half of this year should be on the cards, and we believe that we are well positioned to see a recovery as a result of our own sound liquidity and conservative loan to deposit ratios, which in essence should give us room for credit expansion when market environment is more suited. Having said that, I hope I've kept it very brief, less than half an hour. This does bring us to the end of our financial earnings presentation. Thank you for taking the time to join us on this call.